Hey folks, Dan Frio here with your real estate update for today. So on this channel, what we usually go over is where mortgage rates are, the news that's coming out today, the economic news for today and the next few days, and we try to extrapolate that and say, okay, here's what's going on with mortgage rates, and here's what should happen with mortgage rates. Why do we focus mainly on mortgage rates? Well, I'm trying to help you, figure out the home affordability piece of this equation. I don't know what's going on with your housing market. Where do you live? If you live in Austin, Texas, your housing prices might be down 10% and continuing to drop. If you live in areas such as Hartford, Connecticut, you see a 10, 11, 12% appreciation rate. So where are you? Where do you live? That's going to determine, is it a good market to buy or sell? Or, do you even qualify for a mortgage? So I'm going to explain that to you at the end of this video. So pay attention, and you can ask questions down below. I'd love to answer those questions. At the end of this video, I'm going to go over with you how you can reach out to us to assist you if you're looking to buy your first house maybe in this market, or maybe you're looking to buy your first investment property. So let's get to it. Here's the top 6 programs people use when they're buying their first house. Rate-wise, they're basically stagnant. I said yesterday we might see a little reprieve in rates up or down, maybe 1, 2, 3 ticks. That's exactly what happened. We had the 15-year go up just a tad and the 30-year fixed down just a tad. But if you look over there, the 52-week high, 8.03%. That was less than a month ago. So rates are down almost 0.75% in the last 30 days. So let's get over to the economic news to figure out what's going to happen today. So what we do with that is we go over here, and the only data in really today is GDP, and I'll explain that. I'll take a little bit deeper dive into that here in a second. So you have the GDP numbers, retail inventories, they're depleting, which that's good for the good for the companies that are holding these merchandise, but it's coming holiday season. So if you're depleting a lot of this inventory, what's going to happen? Are we going to have some shortages in some areas? And then that's about it. So let's get over to the headline news that we see in CNBC to take a deeper dive into some of these topics. So what you look at right here is U.S. GDP grew at a 5.25 rate or 5.2 rate in the third quarter, even stronger than first indicated. So what is GDP? Why should we even care? Well, the reason being is, what is it? Gross domestic product, a measure of all goods and services produced during a 3-month period, accelerated 5.2%. That means workers are making more and more and more stuff. Okay. The good news about that is the more of a thing you have, the less the prices, or the less likely are the prices are to go up. Okay, so that's kind of the good news there. Workers are back to work. A lot of unions got raises for their employees. It's all good news on that front. Now, let's go down through some of the areas that's a little concerning. Government spending. Now, you guys know how I am on the government spending. Government spending also boosted in the third quarter, rising 5.5% from July through September. You imagine if you and I increased our spending 5.5%, that would be pretty much catastrophic for our budget. But unfortunately, the federal government, I don't really know if they care at this point. So we'll only see how this deficit is going to play out a role in our history, as years and years and years go by. But let's take a little bit deeper dive into this. However, consumer spending saw a downward revision, now revised just 3.6% from 4%. So that means people are starting to buy less, which is great. So we're going to have probably a little more inventory because of our GDP. Companies aren't holding as much inventory, so we have to produce this, but the consumer's starting to slow down. Kudos for that. But unfortunately, we've been gouged this whole time. How can that be proven? Well, right through here. Corporate profits accelerated 4.3% during the period, up sharply from the 0.8. So this means companies are having higher profit margins. How are they getting that? Well, wage growth, they're paying a little bit higher in wages. It's not their supply chains. What is it? Well, it's prices. They're increasing the prices of everything, and we're seeing that. That's the biggest thing that is inflation. Okay, so that's what we're seeing there. So based on this news, the one thing that you guys might not remember is the Federal Reserve is meeting soon in 2 weeks. So what's the probability this time that the Federal Reserve is going to be increasing interest rates? Well, funny you ask. Let's go over to the Chicago Mercantile Exchange, because they have a tool that watches exactly this. If you watch this is the Chicago Mercantile Exchange. They have a Fed Watch tool. What is it? Well, let's scroll down, and it is, what is the likelihood that the Federal Reserve will change the federal funds target rate at the next meeting? Well, the next meeting is 14 days away. So I want to explain to you real briefly what the federal funds rate is. The federal funds rate is the only interest rate the Federal Reserve controls, okay? It basically controls short-term interest rates. So what exactly it is it's how banks borrow from each other. That's the interest rate that they pay. But when the banks have to pay more, they're going to increase their interest rates to you and me. So we're going to see when the Federal Reserve raises rates, banks are then increasing rates on short-term maturity loans, credit cards, car loans, personal loans, and things like that. So right now, the federal funds rate, just if you don't know, is 5.25%. So let's go down into this calculation and see what the projections are for it to change. So right now, there's a 98.5% probability of what? Well, to stay at 5.25. Okay, so that's where we're expected to be. Now, if we extrapolate this data out, I want to show you guys a little tool here that we have on the CME Watch tool, and it tells us what the Federal Reserve expects to do with rates over the next few years. Okay, this is really important because this is what's called the dot plot. Okay, what the dot plot is every time the Federal Reserve meets, well, I'll say it this way. 4 times a year when they meet, they create this dot plot. What they do is all the members of the Federal Reserve sit there and they put a little dot on where they want the federal funds rate. So in 2023, here's what you're seeing. So you're seeing the dot plot is right here. And if you look up right through here, it's saying that the federal funds rate should be between 5.5 and 5.75. A little bit of increase because if you remember, right now we're at 5.25 to 5.5. So that's why everybody was saying, well, the Federal Reserve is going to raise rates by the end of this year. Well, the probability of them doing it at the last meeting, what we just saw previously, was there's a 98% chance that they're not going to do anything. Now, let's look out to the following years because again, guys, this is the Federal Reserve actually members putting dots on where they expect their rates to be. So if you look at this, the consensus vote is right here. What is that rate? Well, if you extrapolate over there, it's 4.25 to 4.5. Well, that means we're at 5.5, 5.25 to 5.5 now. They're expecting, the Fed is expecting it to be 4.25 to 4.5 next year. So that means they're projecting themselves to reduce rates by 1 full % next year. And then look over here in 2025, it's a mess. Nobody really knows what's going on. So that's what's happening behind the scenes right now. So based on all this news that we have today, what's going on with mortgage rates? Well, to do that, what we do is we follow the mortgage-backed security bond. Why would you follow anything else other than me? Because I'm going to explain this to you on a daily basis. So what we follow on this channel is what's happening to the mortgage-backed security bond. This bond trades on Wall Street, and its yield is the biggest component of your mortgage rate. So that's why we follow it. No use following any other bond. So what you're seeing right through here is this is the price of the bond. This right here is the adjustment that's taking place so far today. If you squint a little bit, I got a green screen, that's why this is dark, it's up 20 basis points. All you need to know is this. If the price of the bond goes up, the yield goes down or the interest rate goes down. Okay, that's it. There's an inverse, a yin-yang relationship. Though you see this trajectory of this right through here, that's a huge run for this bonds. So every time this thing ticks up, mortgage rates are coming down. So today we're probably going to see maybe a 0.03, 0.05 reduction in rates. But you saw it right there, folks. It went from plus 20 to plus 11. So there's big moves throughout the day that you guys don't see on mortgage rates. This is what we see and we monitor on the back end of things for you. So if you want to reach out to us and you're like, Dan, what do I do? Let's say I locked in my rate. Am I stuck with my lender? If you locked in with us, we're going to monitor this on a daily basis to make sure we pivot with the markets and get you that lowest rate. But if you're out there and you're locked in at a credit union, a bank, another mortgage company, you're probably locked in. There's nothing you can do. So as we saw earlier, rates were 8% less than 3 weeks ago. Now they're 7.3%, a big drop. This could save you a lot of money. How do you reach out to us to get some guidance to see, can we get you a better rate, lower fees, or maybe all the above? Well, upload your loan estimate right into that field right there, loan estimate. How you get a loan estimate is when you apply for a loan somewhere, they have to send you a package. Part of that package is the loan estimate. It goes over the purchase price of the house, the loan amount, the interest rate, and all the fees. We're going to analyze that with over 70 lenders throughout the country to make sure you're getting the best deal out there. But if you're just starting this process and you're like, Dan, I really don't know if I qualify, well, all I ask you to do is don't disqualify yourself. Are your credit scores high enough? You might be surprised. Do you make enough money? Oh, let's check that. Do you have enough money for a down payment? Those are all the things that we're going to answer when you get in touch with us. How do you get in touch with us? Well, 3 ways. 1, you can hit the Apply Now button, fill out some information. We're going to set you up with a specialist on our team that specializes in the mortgage that you're looking for. Or you can go down through here, from the rate update. Our website's therateupdate.com. You can scroll down. You're going to see blogs and websites and other tools here. You're going to see mortgage calculators. But then when you get to the bottom of the screen, you're going to see our 800 number and my email address. 800 number is 844-775-5626. Love for you to call. But if you want to reach out to me directly, email me at dan@therateupdate.com. And yes, folks, it is me getting those emails, and I will be the one responding to you. So thanks so much for watching, guys. God bless. If you haven't subscribed to my channel and you like it, please make sure you do that down below. Take care. Have a fantastic day, and I will see you tomorrow. Bye-bye.